So another fundamental accounting standard that you have to be mindful of is this guy, IFRS 9, financial instruments. One of the sweetest accounting standards that you must understand, because it's really very simple standard. Only that people, you know, are not able to wrap their head around it. Generally, financial instrument it's created when on one side a party, so there are two parties to a financial instrument transaction. There is party A and there is party B. So on one end, one party will be recognizing a financial asset, okay? Then another party will be recognizing a financial liability or an equity instrument. Sounds good? So like two parties. One will be recognized financial assets, one will be recognized financial liability or equity instrument. Now, when do we say this is a financial asset? We say it's a financial asset if we hear things like, oh, the entity bought, the entity purchased, okay, bought, purchased, or acquired. All right, but we hear of liability of or equity when we hear things like, oh, the entity sold. Okay, the entity sold, the entity issued. Okay, the entity sold, the entity issued. All right, that is the idea about that. Or the entity raised finance, that kind of thing. So it's about your choice, it's about the choice of words. Any financial instrument question you will see these words coming in there. And you have to be mindful in whose books you are, because that is what will guide you as to whether you are dealing with a financial asset or a financial liability or equity. So meaning that the party B can either recognize an equity instrument or a liability instrument, can recognize equity or a liability. When can the party recognize an equity or liability instrument? We ask a golden rule question. And the golden rule question is, does the entity have an obligation to repay or redeem the debt? To repay? Does the entity have an obligation to repay? If the entity has an obligation to repay, then it's a liability. So yes, it's a liability. If the entity have no obligation, no, then it's an equity instrument. So the party B deciding whether to recognize a financial liability or an equity instrument depends on that golden rule question that we are going to be asking ourselves. Once we establish that golden rule question, boom, we can then go ahead and do the recognition. Then the party B in question can also issue what we call a convertible loan note. Okay, can also issue what we call convertible loan notes. Now, when convertible loan notes are issued, as per IAS 32, financial instrument presentation, it has to be treated as a compound financial instrument. So we have to recognize both an equity element and a debt element. But that is going to be also in the party B. That is, if the party issued or sold or raised finance by issuing convertible loan notes, raised finance by issuing a convertible loan note. So the question then is, let's start from the perspective of the party A, who is buying, who is purchasing, who is acquiring the financial instrument. It could be shares, it could be bond that they are buying, or whatever it is that they are buying. So if it's a financial asset, the question we ask ourselves is, what is the treatment generally? The way financial asset is dealt with depends on the objective of the company for the acquisition of the financial assets. Usually, if the financial assets they are buying, they want to use it for trading purposes. Okay, trading purposes, meaning that they are buying it to make some gain and go away, or they want to, not for trading purposes, but as part of long-term strategy generally of the at the end of the day, or the entity want to hold to maturity so they can get the money coming in every year from the instrument that they have bought. So these are the two options available. Why is this important? Because if this for trading purposes, it means that the transaction cost that is incurred, any transaction cost incurred is written off in the P&L account. Okay, it's recognized in the profit or loss account. Okay, then after that, on subsequent measurements, any fair value gain or loss is recognized in a P&L account. Any fair value gain or loss is recognized in the P&L account, in the profit or loss. That is the idea about if we are buying the shares for trading purposes, or sometimes it's called for speculative purposes. Okay, speculative purposes. It means that the entity has estimated that this is just an example. Okay, maybe the entity has estimated that, all right, currently MTN shares in Ghana, it's whatever, let's say 1.25 Ghana cedi per share, but MTN is about to make an announcement, and so we expect that if they make the announcement, please, this is just an example. Okay, it's not true. I'm just using it, making an example before people go and do some things. So maybe the MTN is about to make an announcement, and we think that if they make announcement, their share price will jump by maybe 25%. So it means that we are buying the shares today, but it is for speculative purposes in that particular case. We are buying the shares today, but it is for speculative purposes at the end of the day. So in that case, transaction costs incurred in the acquisition of the shares or purchases of the shares will be recognized in the profit or loss account, and the fair value gain or loss is going to be just, also recognized in the profit or loss account. But if it is part of the entity's long-term strategy, then what's going to be happening is that the transaction cost will be included in the initial cost of the financial asset. Okay, the financial cost will be included in the initial measurement of the financial asset. You got to be careful here. So in financial asset, what then is going to happen is that we'll bring the fair value, how much we paid for the financial asset. Then you add TC, that's transaction cost, and that gives you the initial measurement in that particular case. Whether it's a debt instrument or an equity instrument, the transaction cost is added as far as the entity is acquiring that not for speculative purposes, but as part of its long-term strategy, and most importantly, or they want to hold to maturity. In that case, what then happens is that any fair value gain or loss, if it is an equity instrument, okay, because on subsequent measurements, the way it will be dealt with is whether it's an equity instrument or not. So if it is an equity instrument, all right, then fair value gain or loss, it's recognized in the OCI. Fair value gain or loss is recognized in the OCI. That's other comprehensive income. But if it is a debt instrument, on the other hand, and most debt instruments may not be traded on an active market. So if the debt instrument is not traded on an active market, then it will be carried at amortized cost. Okay, it will be carried at amortized cost. And in that way, what happens then is that the effective interest rate will be recognized as income in the P&L account. So that is the idea about, financial asset and the way you deal with it. So in the question, if the question is quiet, you may choose either of them. Just that if the question is quiet, we will assume that a company is holding on it for speculative purposes. So that is the default treatment. But really, if the question is quiet, you could go either way. It will be marked for you at the end of the day. But mostly in questions, you will have the context of whether it is something that the entity has bought as part of its long-term strategy, or it is something that the entity has bought as part of or to make some short-term gain that is for speculative purposes. And that will inform us on the way the transaction cost is going to be treated, and then on subsequent measurements, how we are going to be accounting for the instrument in question. Does that make sense? Any questions? Everybody good on that? That's the idea about that. On the financial liability situation, it's pretty simple. On financial liability situation, that is, if the company is the one issuing, okay, the company is the one selling, the company is the one, receiving the money at the end of the day, then what is going to be happening is that the financial liability FL is recognized at fair value, is recognized at fair value less transaction cost. So if somebody asks, Nhyira, the transaction cost, no, when do we less it? When do we add it? If you ask that question, it means you've not opened your brain up to understand financial instruments. If it is a financial asset, meaning the company bought, and it is a financial asset that they are holding on as part of a long-term strategy, they want to hold to maturity, then the transaction cost will be added in arriving at the initial amount at which the financial asset should be carried on. But if it is a liability, always the financial or the transaction cost is going to be less. And that is the initial measurement. That is the initial measurement. Then on subsequent measurement, what is going to happen is that you're going to carry it at amortized cost. Okay, the financial liability is carried at amortized cost, and any finance cost will be recognized in the profit or loss account. It's carried at amortized cost. So Nhyira, when do I subtract financial liability? When do I subtract add financial? Sorry, when do I subtract transaction cost? When do I add transaction cost? It is the context of what you are dealing with. If it is an asset, financial asset, and the company bought it for trading purposes, for speculative purposes, then the transaction cost will be written off in the P&L account. But if the entity bought the financial asset or the financial instrument and they want to hold on it to maturity, they want to hold on it as part of their long term strategy, then the transaction cost will be included, will be added in the initial measurement of that particular instrument that they have just purchased. However, if it is a financial liability, as far as there's a transaction cost, it will be subtracted from the fair value of the financial liability and the carrying that will give us the initial measurement. Then on subsequent measurement, we'll carry it at amortized cost, and we will calculate any effective interest rate, and that will be finance cost in the P&L. But remember, in a financial asset environment, if we are applying amortized cost, we will have a finance income, because here we bought an asset. So here there will be finance income. That is the idea generally, and the key principles that you have to pay attention to when it comes to dealing with financial instruments.